Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at stock.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And this one is, it's a really fascinating situation. We're looking at an integrated LNG to power company that is, well, it's the definition of a high-risk, high-reward play.
Right. It feels like a real binary outcome here. Either it goes to zero or, it's a huge success. You have to weigh this crushing debt against some pretty unique assets.
Exactly. It's a classic battle between the balance sheet and the underlying business.
Okay, so let's start there with the balance sheet. Let's unpack the downside first. When you talk about immediate financial stress, what are the biggest red flags jumping out at you?
Well, the first thing you see is just the sheer amount of red ink. Their latest net income on a trailing 12 months basis is a loss of over $1 billion.
$1 billion, wow.
Yeah, negative $1.01 billion. And it's not just an accounting loss. If you look at their core operations, their adjusted EBITDA for the second quarter of 2025 was also negative.
And that's a massive signal, right? When even the core business isn't generating cash before all the big expenses.
It's a huge signal of distress. It means they can't even cover basic operating costs from their operations. This is coming from a few places. You have really high restructuring costs, massive interest payments, and then significant delays on their key projects.
Which projects are those?
Specifically in Puerto Rico and Brazil. These were supposed to be the big cash cows, but they just haven't come online as expected. So you have all the costs, but none of the revenue.
And that brings us to the debt. I mean, you can't have those kinds of losses without a huge debt pile funding it. How bad is it?
It is. It's crushing. The total debt burden is over $9 billion.
$9 billion.
But it's the leverage ratio that's truly terrifying. Their debt to EBITDA is projected to be over 15 times for the next couple of years.
15 times. I mean, for context, a healthy company in this space would be, what, 2 or 3 times?
Low single digits, exactly. 15 times is, it's a sign of extreme, almost terminal stress. It's completely unsustainable.
And what does that debt cost them every year? Just to stand still.
That's the killer. The annual interest expense is around $900 million.
So nearly $1 billion a year just to service the debt before they can even think about profit.
That's the treadmill they're on. And it's why the credit markets have started to, send very clear signals.
What's the most critical sign we've seen from the creditors?
It's the rating action. S&P Global recently downgraded them to SD.
SD, what does that mean for them, practically, for the listener who doesn't live in the high-yield credit world?
It stands for selective default. It's basically the market saying a default event has already happened on a specific part of their debt, or it's about to. It signals that restructuring is almost a certainty and that their liquidity is, and this is a direct quote, highly constrained.
So the well is dry.
Essentially, yes. They're burning cash, they've breached covenants, and access to new money is basically shut off.
Okay, so with that kind of pressure, management has to do something. They can't just sit there. What have they done to, buy themselves some time?
They've been in intense negotiations. The key event was in November when they executed what's called the 11th Amendment to a major credit agreement.
The 11th. So this isn't the first time they've had to go back to the banks.
Not at all. This is a long-running saga. This amendment basically gave them a covenant holiday. It suspends the key financial targets they have to meet for the third and fourth quarters of 2025.
Okay, so it gives them some breathing room, but that never comes for free. What did they have to give up?
A lot. They're now under strict limits. No more dividend payments, for one, and they have much less flexibility on how they can service their other debts. The leash got a whole lot tighter.
So they kick the can down the road, but the road is getting narrower.
That's a perfect way to put it. And there's a new, very hard deadline. The maturity for this amended agreement was extended, but only to March 31st, 2026.
March 31st. So that's the day. That's the moment of truth.
That is the pivotal deadline. They have to solve their entire capital structure problem before that date, where, well, the trajectory gets very, very ugly.
Okay, so that's the downside, and it's incredibly bleak. So let's pivot. Why is anyone still paying attention to this company? There must be something of value under all that debt.
There is, and that's what makes this so interesting. The market is pricing this for bankruptcy, But the company has a massive competitive advantage.
Yeah.
They are a first mover in integrated LNG to power. They have assets that are, almost irreplaceable.
You mean the physical infrastructure?
Exactly. These are huge, complex projects in key markets. We're talking about their operations in Brazil and that critical facility in Puerto Rico. You can't just go out and build another one of these tomorrow. It takes years and billions of dollars.
And Brazil is the main driver of that potential value.
It's crucial. If they can get the execution right, the Brazil operations are expected to drive about 30% of their projected EBITDA going forward. These assets have tremendous long-run optionality if they can survive the current crisis.
Okay, so let's put some numbers on that optionality. If they pull it off, if they get the refinancing done and the projects start humming, what does that upside actually look like?
It's what we call asymmetric. Analyst forecasts are, they're all over the place. The range is huge, from maybe $2 to $8.50, but the median analyst target is $7.70.
$7.70. From where it's trading now, around $1.60, that's what, over 400% upside?
It's a massive potential return, over 427%. But, and this is the biggest but you'll ever hear, that 770 target is entirely dependent on them successfully restructuring. It's a bet on the outcome, not on the current business.
A bet on the negotiation. Okay, so how is the market itself, the stock price, reacting to all this drama?
Well, despite the long-term cratering, there's been a pretty strong short-term rally from below $1.
Yeah.
But the really telling thing was the reaction to that 11th Amendment news.
What happened?
The stock surged 20% in after-hours trading.
20%. So the smart money sees that as a sign they might actually survive.
It signals that institutional investors are betting on the process. They see the debt relief, even temporary, as a sign that there's a path forward that avoids a total wipeout of the equity. From a technical standpoint, $2 is the next big hurdle, with support around $1.20.
With that kind of institutional interest, there must be speculation. What's the chatter? Is there a white knight scenario being floated?
Oh, the speculation is running rampant. The most plausible rumor is asset monetization. The idea that they'll sell off some non-core international assets to raise cash and meet the new credit terms.
Selling the furniture to pay the rent?
A classic move. Then you have the bigger rumors, whispers of talks with major energy infrastructure funds or even sovereign wealth funds about a massive capital injection.
The kind of players who can write a check big enough to actually solve the problem.
Exactly. And then there's the really high-risk, high-reward rumor.
Okay, let's hear it.
The chatter is around potential FEMA claim receivables from their Puerto Rico assets.
FEMA, from hurricane damage and things like that.
Precisely. The number being thrown around is, well, it's somewhere between $1 and $2 billion.
A $1 to $2 billion check would change everything. That solves their liquidity problem overnight.
It would be transformative. But, and I have to stress this, you have to be extremely cautious. The major rating agencies and analysts do not include these potential inflows in their official forecasts.
So if you're betting on that, you're purely speculating. It's a lottery ticket.
A very high-stakes lottery ticket, yes.
Understood. So let's focus on what we do know. What are the key dates investors need to have circled on their calendars?
The next 3 months are everything. First, December 5th, 2025, that's the Q3 filing. We need to see an update on their liquidity and any progress on the project execution.
Okay, what's next?
Then, around January 30th, 2026, we get the Q4 earnings report. This is their last big chance to tell the market exactly how they plan to meet that March deadline. Any vagueness there will be punished severely.
And then the big one.
And then the big one, March 31, 2026. The hard deadline for the credit agreement. Their ability to get a long-term solution in place before that date will, determine everything.
So it's all pointing to that date. The conclusion really is that this is a true binary stock. Failure to navigate the debt before March means catastrophic risk.
But success unlocks that strategic asset base for a potentially huge multi-bagger return. The outlook really summarizes it perfectly. Stock's financial position is under severe pressure, signaling elevated restructuring risk into early 2026. For you, the investor, the decision lies in whether the unique strategic asset base and the potential for a massive multi-dagger return justifies the very real risk of high distress and continued volatility. You are truly betting on the outcome of a financial negotiation as much as on the underlying business.